In this video, Classification of Liabilities Part 2, we will look at the three most common categories of equity: preferred stock, common stock and paid in surplus, and retained earnings. Preferred stock has the characteristics of both long-term debt and common stock. What does that mean? Preferred stockholders take higher risk as compared to long-term lenders, but lower risk as compared to the common stockholders. How does that work? When a company is doing good and it distributes its profits to the owners, the preferred stockholders get their share of the profits first. After their share of profits is paid, the common stockholders get their share of profits. Here I just want to remind you that share of profits that stockholders get is called dividends. So preferred stockholders get a preference in payment of profits, which is called preference dividends. This preference becomes important when a company becomes insolvent or goes bankrupt. When a company goes bankrupt, all its assets are sold and the money that's available on the sale of assets is first paid to all the lenders. After the lenders are paid, the remaining money has to go to the equity holders. Here, the preferred stockholders get preference over common stockholders in receipt of their money. That's why they're called preferred stockholders. Another point to note in payment of profits or dividends is that the preferred stockholders are guaranteed a fixed amount of dividends forever. This is different from the common stockholders, for whom the dividends are variable and never guaranteed. Both common stock and preferred stock represents ownership in a company and a claim, i.e. dividends, on a portion of profits. But common stock is the fundamental ownership claim in public or private company. Common stockholders get voting rights and therefore have a say in the management of the company. Over long term, they get highest return as compared to other classes of investment. This is because their dividends increase as the company does well progressively. So their high risk is paid off with high return. The third type of equity is called retained earnings. Retained earnings is that part of earnings or profits of a company that is retained or held back by the company for reinvestment in the company operations for expansion or other purposes. For example, if a company has earned $500,000 of profits in a year and it distributes $100,000 of its profits as preferred dividends and $250,000 as common stock dividends, what is left? 500 minus 100 minus 250. Okay, so that money that is left after paying preferred stockholders and common stockholders is called retained earnings. So it is still left with a profit of 150,000, i.e. 500,000 minus 100,000 minus 250,000. This 150,000 that is retained by the company is called retained earnings. This money actually belongs to common stockholders because it comes from the profits, though it is reinvested in the company operations. And that's why it appears as part of equity. To sum up what we learned, liabilities are monies owed by a company. The liability types are current liabilities, which are repayable within 1 year, i.e. accounts payable, provisions and accrued expenses, long-term debts, equity, i.e. preferred stock, common stock and retained earnings. Now let's look at some numbers. Recollect the example of cogs and wheels that we discussed in the previous video. The asset side of cogs and wheels looked like this. We had the current assets amounting to $25,000, fixed assets amounting to $380,000, and the total assets, which was the addition of current assets and fixed assets, amounting to $405,000. So how were the assets financed? Cogs and Wheels owed $6,000 to its vendors, repayable over the next 1 year. It declared a bonus of $2,000 to its employees before Christmas, which was payable after the New Year's. The tax liability estimated by its accountant amounted to $3,000. It had a 10-year loan from the Chase Bank to the tune of $250,000. The owners of Cogs and Wheels brought in equity of $120,000. After paying the profits, Cogs and Wheels had a retained earnings amounting to $24,000. Now, can you construct the liabilities side of balance sheet with these figures? Yes. Let's first look at the $6,000 that Cogs and Wheels owed to its vendors. What is this amount? This amount is the accounts payable, which appears under the current liabilities of Cogs and Wheels balance sheet. Then this $2,000 of bonus that it has declared to its employees before Christmas, which is payable after the New Year's, is accrued expenses because it's payable after New Year's, that is payable within 1 year. Then the tax liability estimated by its accountant, it's an estimate, appears as provision for taxes, $3,000. So if you add $6,000 plus $2,000 plus $3,000, you get $11,000 of current liabilities. Then if you look at the long-term debt, it had a 10-year loan from Chase Bank to the tune of $250,000. That appears as long-term debt here, $250,000, because it's 10-year loan. The owners of Cogs and Wheels brought in equity of $120,000. That's here. Then the retained earnings amounted to $24,000. That's here. So if you add 11 plus 250 plus 144, you get $405,000. And you can see the liabilities are appearing according to the maturity. Those liabilities that mature earliest come on top and the remaining are at the bottom. So if you put the assets and liabilities together, what you get is the balance sheet. And the balance sheet looks like this. Assets on this side, liabilities on this side, and you can see the assets and liabilities are equal. With this, we come to the end of balance sheet. Please do the quiz on this topic and we'll meet the next class. Thank you.